Hello, everybody. Welcome to this discussion hosted by ClearlySo. ClearlySo is Europe's leading impact investment bank. And I'm delighted today to say that we have Will Lowry and Jon Wright with us. They're from our institutional sales team. And in these very unusual times, they're going to give you shortly some insights onto what's actually happening in the market, in particular for private equity and venture capital transactions. Why don't we start with you, Jon, if you could briefly introduce yourself to the audience.
Sure, thank you, Rod. So my background is in private banking. I spent most of my career, 10 years. Like many others who've moved across to impact, I am inspired by the ability of capital to transform markets and global development. I actually tried to convince my bank at the time to get into impact investing, but that was unsuccessful. So I looked around the market and I joined ClearlySo in 2015. And my role here includes growing and developing our institutional investor network and marketing investment opportunities to them.
Thank you, Jon. Will, how about you?
Yeah, thanks, Rod. My background is very much investment banking focused, having spent the first 5 years of my career at the likes of Numis, the UK's leading institutional stockbroker, Credit Suisse and GemCorp Capital, a private debt fund with over £1 billion in AUM. I helped to raise over £100 million for corporate clients across each of these roles, largely within the tech and energy sectors. I joined ClearlySo back in November of 2018, having first come across the concept of impact investing during my MBA at IE Business School in Madrid.
Thank you, Will. And to round things off, my background is as an equity research analyst in the United States with Payne Weber, focusing on the financial sector. I came to Europe and worked with Lehman Brothers, where I was eventually head of equities in Europe for Lehman Brothers. Moved later in the 90s to Paribas to run the financial institutions group on the corporate finance side before founding a VC firm with a focus on fintech, which I did between 1997 and 2007. And then 2008, in the very week that Lehman Brothers collapsed, ironically, ClearlySo was formed, and we've been going strong for 12 years as an impact investment bank. So guys, these are obviously really unusual times in the markets, a little bit of a bounce back recently, but most major markets are still down anywhere from 20 to 40% as a result of what's happened with the pandemic. You guys are mostly involved in the private equity and VC area. Can you comment briefly on what sorts of declines you're seeing in the market and what are some of the particularities of that? Jon, why don't we start with you?
Okay, yeah, thanks, Rod. Well, look, investors are still understandably heavily involved with portfolio management and are really lacking bandwidth to review new opportunities. This will hopefully ease in the next 6 to 8 weeks as the scale of COVID-19 corporate casualties becomes a bit clearer. But there does remain a lot of uncertainty around when this will all end, and this is obviously affecting sentiment. We're already seeing valuations coming under severe pressure and some aggressive haircuts to base case revenue forecasts. The expectation is that only high quality investment opportunities will be prioritized to make it through to being reviewed in the short term, and ones that are marginal are being deprioritized or unfortunately being dropped altogether. But that said, it's important to remember that private market investors have a long-term view and remain excited by companies and sectors that will thrive in a post-COVID world. So when bandwidth and sentiment permits, I'm sure they will be actively seeking new opportunities.
I might jump in there, Rod, because I think it's definitely worth diving further into Jon's comments around valuation. For me, this is the key impact that the coronavirus has had and is likely to have on both the PE and VC markets. When speaking to our own investor network, it certainly seems as though the impact on public markets has almost been directly mirrored across to the private markets, with a close VC relationship of ours citing a 30 to 40% decline in SaaS forward-looking revenue multiples since the start of the year. But this really should not come as a shock. COVID-19 has opened a Pandora's box in terms of uncertainty, and investors hate uncertainty. The valuations are determined by the extent of an investor's confidence in future cash flows. And this is hugely dependent on both the visibility of demand, as it were, for a company's services, so near to medium term revenue generating potential, and the broader macroeconomic outlook, which has an inherent impact on potential exit routes. COVID-19 has thrown both of these aspects into doubt, and with no real visibility as of yet to the effect that the crisis has had on growth, revenue, M&A and IPO activity, investors are going to be quick to assume the absolute worst for both. For example, as John just mentioned, when it comes to the visibility of demand, we've seen our own network hold a pretty unanimous stance on base case forecasts, citing again a minimum 40 to 50% haircut to short-term revenues, pretty much across the board. Likewise, on the exit assumption, we also expect investors to buck the current trend, with the recent decade low in the median time taken by EU VCs to go from founding to exit at risk of being delayed or pushed back from 7.8 years, as was reported by PitchBook, to closer to the 9 to 10 year mark that was more associated to the years immediately post the financial crisis. I think, lastly, because I'm a bit conscious that I've rattled on a bit here, there are, of course, other factors at play, supply side dynamics, with an expected scarcity in capital for new investments over the next 4 to 8 weeks, at the very least. Entrepreneurs are going to have to face the stark realities of what is a true buyer's market, in which the broader impact on valuations across the sector as a whole will absolutely be significant.
Will, can I just follow up on one thing? You said that, for example, in the SaaS revenue models, that people are now using multiples that are 30% to 40% lower. But it's also, based on what you said, clear that those revenue expectations are going to be a lot lower. So does that mean that actually the drops in prices will be significantly higher than the 30 to 40% you mentioned?
Yeah, I think so. Every deal is going to be reviewed on a dual basis. So you've got kind of the compounded effect of a depressed multiple and a much more conservative forecast. So, my outlook on valuation, which is why I kind of stated it as being the key impact of COVID, is going to be pretty significant.
Yeah. Now, you guys in particular, I know that ClearlySo focuses across the piece in terms of the organizations with which it works, but in particular, there are 4 sectors that I know dominate what ClearlySo does: education, health, clean tech, and responsible consumerism. From your perspective and from the literally hundreds of conversations you've had over the last few weeks, would you say that there are any sectors here that seem under particular pressure to you at the moment, or any broad sectors that you think are doing relatively better? Maybe, John, let's start with you.
Okay, sure. Well, I like to focus on positives first, if I may. So I will just say that we're seeing some really great opportunities in healthcare and education that are reporting a strong uptick in sales specifically as a result of the coronavirus. For example, in areas such as telemedicine, remote monitoring of patients, and in education, online learning, upskilling, and child development. I will praise Will and other CS colleagues who recently closed a Series A round for Oddbox. This is a wonky veg delivery business, and their business is just exploding right now, as you can imagine. Even before COVID, the business had really impressive traction. In terms of those who may struggle, beyond the obvious in travel, retail, and leisure sectors, anything that involves non-essential, high-value consumer spending will undoubtedly find it quite hard. For example, B2C energy-saving smart tech is perhaps just one example of this.
Will, is there anything you'd like to highlight in more detail?
Yeah, I think it's definitely worth focusing on healthcare, or more explicitly, digital health, which has to be, in my opinion, at the top of any investor's agenda at the minute. Dealroom published a great piece of research titled Impact of the Corona Crisis on Startups and Tech, in which healthcare was shown as being the only sector to have recorded a positive share price movement since the 31st of January, increasing 13% against an average decline of around 25% across mainstream tech indices over the same period. One of the best health tech investors that I speak to, in fact, I'd probably go as far as saying the specialist health tech investor across the UK VC scene, 10x Health, has been calling out for this acceleration of technology into the NHS and other global health system as a fundamental requirement of modern society. COVID-19, while an incredibly unfortunate event, has certainly sparked a long-term and structural shift in how the healthcare sector will operate going forward. And digital solutions are likely to play an absolute leading role in this. But it's not only healthcare. The lockdown has effectively opened consumers' eyes to the digital front door, as it were, with almost every single sector currently outperforming the market, being heavily reliant on a digital offering. So streaming, e-commerce, food delivery, and obviously SaaS plays. I think looking at it from an impact perspective, given our role as the leading impact-focused investment bank, it's also important to reflect or consider the implications that the coronavirus crisis has had on our everyday lives, as these changes could all soon evolve into new societal norms. An example of this specifically was recently discussed by an investment group who we know and are close to, who are focused on sustainable nutrition. They stated that the primary cause of COVID-19, SARS, avian and swine flu, along with approximately 75% of newly identified human pathogens, are all originated at the human-animal interface. This means that future disasters like this could potentially be avoided, or at the very least limited, should society adopt technology as a solution to rebalancing our reliance on animals for food, as well as potentially trying to improve the resilience and transparency of global supply chains. So I think inherently the impact space should also see a lot of upside from this.
Will, you're almost suggesting, and obviously it would be in our interest to say this, but I'd really like to tease out something you're hinting at, which is that companies that generate impact, companies that are addressing long-standing societal problems, may actually fare better in the world you're looking forward to, or would that be going too far?
Well, it sounds like we've placed that now, so I'm a bit conscious that we're going to sound incredibly biased. But no, I do think there is a position for that. Absolutely so. I think that in the past 12 months, John and I have both seen a certain uptick in mainstream traditional investors' appetite for impact investments. I think people are starting to recognize that consumer demand is certainly being refocused towards sustainable products and offerings. And I think that lockdown has maybe offered that moment of reflection where immediacy is less important to people who have more time. And I think they've started to really value those things which they see as having a positive impact on society. So I do think that impact investments will certainly be a key attraction to all investors as and when we come out of this situation.
Yeah, and we've seen that over the last month or so, sustainable or ESG badged funds have probably outperformed slightly. And John, let me pick up. Do you think people are, after the initial wipeout, do you think people are being a bit more discriminating? You went through some areas which were doing better or worse. Do you think there's starting to be a bit more delineation in terms of which are the winners and which are the losers?
I think so. I think there's an awakening of consciousness. So people are really thinking about how they're spending their money or how they're spending their time. I guess just picking up on the food theme that Will mentioned. I mean, the future of food and the dietary switch was a hot topic for our investors even before the crisis took hold, especially amongst family office groups. There are so many opportunities in this space around vertical farming and biotech and Internet of Things. So some really high growth potential things in there.
So a lot of the listeners to this discussion will be entrepreneurs as well as investors. For their benefit, what do you think you can share about the approaches that different investors are taking as a result of companies that are adversely affected by COVID-19. So help them to try to understand the sorts of circumstances in which private equity or VC investors will back these businesses or frankly decide to pull the plug. Will, why don't you take this first?
Sure. I have to say that I have been pretty overwhelmed by the support that investors have offered to their portfolio companies to date. It's obviously easier in some cases than others, but there has been a consistent approach in which investors are trying to work closely with their portfolio companies in order to unpick the true extent of the crisis's impact on the overall demand for the underlying product or service. This is obviously challenging and time consuming, but investors are understandably keen to establish the true cause of a potential decline or stagnation in revenue before reinvesting in the blind hope that the issue is crisis related as opposed to being a more fundamental structural issue. We know that investors have to be selective, and making difficult decisions is a key aspect to their job. And in the unfortunate event where the wider portfolio cannot be remedied, you would expect, the obvious corporate characteristics to determine which entities get prioritized, whether that's those companies with the lowest cash burn, those that have historically performed best, those with a differentiated value proposition, or even those operating in a sector that's expected to flourish when we finally do emerge from the crisis. That said, I think I've been surprised by two newer considerations at play that I've recently learned through my discussions with our institutional investor network. And those are, firstly, a management team's reaction to the COVID crisis, which seems to have become increasingly influential in an investor's decision to back that entity further. So much so that I expect management's response to the COVID outbreak to become a really important aspect of the due diligence process for some time to come.
And is it the speed of that reaction, or is it the extent of that reaction? What aspects should
it's a combination.
Focus on?
It's a combination of the two. I think the key is having a clear strategy and having a kind of a clear communication of that to the investor. So one of the companies that we are working with at the minute, they reacted immediately to the problem. They came up with a specific addendum which highlighted key aspects and key APIs that they had to make sure they were hitting every week. And they were also kind of planning for weekly board meetings, obviously virtual board meetings, but they were being extremely communicative and staying on top of all key aspects of the business so that they could highlight or identify any issues as and when they arise. And I think that's a really important piece to show investors in 6 months' time, 9 months' time, when you're speaking to them. Really reflect on what you did as a company to try and mitigate this risk as much as possible. And an investor, I can always guarantee it, will take a lot of heart into that and a lot of confidence that you are a proper outfit with the ability to forecast accurately as well.
John?
Yeah, investors are backing teams at the end of the day, so strong management teams are really going to prevail. It's a big part of the investment decision. I'm pleased to say, without sounding like we're blowing our own trumpet, that we have actually completed 2 Series A transactions in the last 3 weeks. And that those investors, to their credit, did not deviate away from the terms that were set, although they were agreed in principle pre-crisis. I will add that I spoke to one family office with approximately 150 million in dry powder, who said that they are far more likely to provide financial assistance where they see a need for a balance sheet fix as opposed to a trading fix. So what that means is where there might be loans that need refinancing rather than uncertain future as to when trading will get going again. It's very hard to assess or quantify when trading will take off again, given the current level of uncertainty. Sadly, it's just a fact that there will be many early stage businesses that will go to the wall as a result of this crisis. And we cannot expect mainstream institutional investors to provide charity. So they will unfortunately let some fail.
Thanks, John. Just before we leave that topic, one of the things that I'm seeing is very rapid pivots. So a company may have a B2B and a B2C model, and suddenly they simply close one down and focus on the B2C, and in fact extend it How are investors reacting to that?
That was one of the two considerations that I was mentioning, Rod. It's the second one after management's reaction to COVID. So this has been absolutely fascinating to see. I think evidence of a corporate's ability to pivot successfully, or at the very least try and show initiative to flex their business model in order to navigate this challenging period as profitably as possible, is incredibly well received by an investor. We're speaking to a VC who we're very close to, and they had issued terms to a business which was, in truth, very exposed to COVID and the impact of COVID, specifically with lockdown. And those heads of terms were, potentially at risk, but the company, off its own back, as you said, Rod, pivoted and came up with an incredible solution to the issue, and have actually managed to ensure that they're going to be profitable throughout the entire lockdown period, which for a business which is predominantly B2C, that's pretty impressive. So I think that just adds to the credibility of a management team. I think investors want to see skillful people leading the ship. And if you're able to do that, you're, again, going to be really well placed as a kind of a VC darling, because, well, the investor will have total faith in your ability to kind of get through tricky times.
When we see the loosening of restrictions, which some people think will be later this month, some people think in May, some people think may be delayed until June, what will be the signals that you will look for in terms of a real shift of market sentiment, obviously apart from a turnaround in stock markets? But what do you think people that you talk to are going to be looking for? And also, I'd love to find out from you which areas you think might be the first to benefit from that change in mentality. This one, let's start with John.
Yeah, so I think, look, once widespread testing is readily available, we may see some green shoots of recovery as people begin to get back to work. But my personal view is quite bearish in that things really won't get back to normal until a vaccine is found. And that may be 12 to 18 months away at best. But to be honest, will things ever really get back to normal? We will be approaching a new normal, and no one really knows what that might look like at the moment. As Will pointed out earlier, one thing investors really hate is uncertainty, and that affects sentiment, despite the long-term view of private investors. I think it's unlikely that there will be a V-shaped recovery, as some optimists suggest. Her Majesty's Treasury estimated that 3 million people, or 10% of the private sector workforce, may be laid off temporarily. And when you also consider that 1 in 3 people have less than £1,500 in savings, the consumer wallet, and therefore the addressable market to many businesses, will be much smaller. But once things do get back to some sense of normality, we do expect to see a continued trend of the rise of the responsible consumer. Indeed, it is this trend of conscious consumer spending that has been forcing companies to adapt and helping some mission-aligned companies flourish, such as Bulb. Overall, I think there will be an accelerated shift away from traditional retail towards online, which currently accounts for around 20% of total retail sales, as many more people, particularly the baby boomers, have been forced to become more internet savvy.
Yeah, I know that feeling. Will, over to you.
I couldn't agree more with John on this point, especially with regards to the likelihood of a V-shaped recovery, which in my opinion seems improbable to say the least. The drop-off in consumer spending may well not last more than a quarter or two, but this does not translate into an immediate recovery scenario. As Dan Freeman of Innovia Capital mentioned in a recent blog, an interrupted quarter of growth will need at least 2 to 3 quarters of follow-on growth in order to re-establish the trend required to convey confidence to the next round's potential investors. So applying that, it could take up to a year at the very least until we see these green shoots of recovery, let alone a return to the lofty levels of 2019 VC investment activity.
Yes, and I suppose given the drop-off and the severity of the drop-off in economic activity, it's going to take quite a few quarters of very, very solid growth to even get back to the levels that we've seen. But let me press the question with you a little bit. Do you think there are areas you might look for in terms of the first beneficiaries with respect to investments? So are there sectors of the economy that you think when things start to normalize, people will be starting to look at most intensively?
Yeah, I'm fairly bullish on B2C as a trend. I think that the lockdown, certainly from my perspective, has been pretty brutal and pretty bleak. So I think that when this is all done, we'll see hopefully a lot of people who have saved up a bit of money and essentially have more disposable income that they're willing to spend. So I think that, B2C may see a bit of a recovery. I wouldn't go as far as saying that those sectors like travel, which have obviously been really badly hit, or hospitality, will see an immediate uptick. But I think that there could be opportunity in the fact that they will be so distressed and the valuations will be so low. There could be an opportunity in those spaces if you are willing to take kind of a longer term perspective in your investment, because they should see some recovery in kind of the 12, 15-month period.
Well, that's great. Thank you. I think we should wrap it up here. So on behalf of ClearlySo, I'd like to thank Jon Wright and Will Lowry for their observations. Some of that may have sounded like placements, but I can assure you that these were really spontaneous reactions to questions we had come up with earlier. So we did share the questions with the respondents, but I think the answers are reflective of how they really feel, and most critically, what they're hearing from their investor clients. So this is ClearlySo signing off. I want to wish you all the best in the period ahead. Thank you for listening. Bye.
Thank you.